Hey folks, welcome to InTheMoneyStocks.com's live trading action video. My name is Gareth Soloway, Chief Market Strategist here. Today's date is Monday, March 28th, 2016. Take a look at Sun Edison today, up 13%. It is off the highs, but again, I want to talk a little bit about market psychology, investor psychology to help you understand how this was an easy play. In fact, me personally, I picked up some calls on Friday and I ended up selling them for a beautiful gain this morning. I just had 200 calls, expiration Mays, and I just picked up, really a couple $1,000s pretty easily. And I only paid, I think I paid in the 40-cent range or lower. I don't remember. I have to look. But bottom line is, I want to explain how easy this trade was and why I did the options on it instead of the stock. All right, number one. Take a look right here. So going into Friday, the stock basically was at multi-year all-time lows, right? And we can go to the daily chart, and I can prove the point here. If you look at the daily chart, take a look at it right down here. I mean, this is just a debacle of epic debacles. The chart was $30 stock going back into mid-last year. Basically, a year ago or less, it was a $30 stock. Now it's trading at $1, essentially. And it basically, as of Friday's lows, it was at $1. Now, why was it going to very likely get a bounce today? Well, anytime you go into a 3-day weekend, right? Remember, Friday the markets were closed and we had, the Easter holiday weekend. But what you have to remember is that investors inherently are scared about holding stocks into long weekends because especially in something like this, in this case, Sun Edison, there's been a lot of chatter about bankruptcy. So the natural thought process would be there's a 3-day weekend. Monday morning, the average investor is going to think they're going to file for bankruptcy. So you're going to see a lot of selling going into that weekend. Now, ultimately, if it doesn't happen, some of those shorts are going to cover, which is buyers. Then remember, to cover a short, you have to buy the stock back. And then you're also going to have other buyers that maybe sold, and they're going to say, all right, it didn't file for bankruptcy. I'm getting back in now on a Monday morning when the market's open, right? So that's the mentality to give you the initial jump in the stock here. Now, what I want to do real quick is go back to the intraday here, and let's flip back to that intraday chart, and you can see exactly what happened. So it opened a little higher, and then it got a squeeze right there, and it popped. Now, there was a little bit of a buyout rumor, which is normal. You're going to see those buyout rumors helping things as well. But the whole idea here, folks, is very simple. When you go into a weekend, a 3-day weekend, and there's fear involved, the markets or the stock is going to sell off into that because no one wants to hold over a long period of time not knowing. First of all, it's the anxiety of holding the position, so it's psychology based, right? But it's just the natural occurrence. Human beings think that way. Now, going to why I played the options on this trade, very simple. All right, if I bought the stock and I got the same exposure, all right, I would have had to invest a lot of money. Okay, a lot of money. By basically playing the options, and we're talking about, $10,000, $20,000 in here, which isn't, again, that much, but for a piece of crap like this, yeah, that's a fair amount of money to lose if they did file for bankruptcy, which, as I said, was a possibility, right? I mean, it's a definite possibility. So by doing the options, I got the same exposure as owning, $10,000 to $20,000 of stock here for under $10,000, much, much less. And that's the beauty of it, guys. So basically, I could hedge my risk by playing the options here. And if they didn't file for bankruptcy, I could make some easy money on the pop. All right, ultimately, that's what happened. And we got the pop. My guess was they weren't going to file for bankruptcy. Basically, what's going on with the company is they have to file their annual report by March 30th. If they don't, there's a risk of default. But it's not March 30th yet. They're going to at least wait till that last day, and they could even extend it. As long as they talk to their creditors, they can extend it past March 30th as well. So, I mean, I was banking on that. Granted, there was risk that they did file for bankruptcy, but by playing the options, I was able to mitigate my risk substantially. I was basically able to cut my risk by about 60 to 70%. In other words, invest 60 to 70% less money to get the same bang for the buck to the upside. All right? So I just want you guys to understand how this works out and how I played this. I thought it was a very intriguing analysis, and I wanted to make sure you guys understand. Going into the future, when you have a situation like this, and some people say, oh, I want to be in, I want to do this, this is what you want to do. You want to look at the options. If you have to be in, if you think you have a good risk reward, do it that way. All right, guys? And bottom line is, you want more information, you want more trade alerts live, swing trades, come to InTheMoneyStocks.com. I'm giving them out every single day, basically, folks. And again, there's plenty to be had in this market environment, good setups to be had. And again, folks, it is all for the taking. Join the Research Center. Take the 7-day free trial at InTheMoneyStocks.com.